Hello, it's Robert Miner with Dynamic Traders Group with a special report of DT Major Trends and Reversals Update March 23rd, Part 2. I'm updating the special report that I did just 1 week ago. I think it was dated March 15th, and that was on dollar, euro, gold, silver, and the SPX. And the reason I'm doing this update, both the written and the video updates this week, just 1 week later, is because immediately after issuing that report and showing the bear reversal signals for the dollar and bear confirmation signals, this past week, those were made. So it's real important to understand what is the position of the market and what signals were made and why they're important, as well as what could invalidate those reversal signals. So it happened very quickly after that report was issued. So I'm going to update that this week. You definitely want to, if you haven't yet, read the written report, the Part 1 written report of the video of the DT Major Trends and Reversals from March 15th, you really should do that before you listen to this report because that gives the more comprehensive view of the long-term position and why we're looking at probable major reversals in some of these markets. And this is the update that's going to explain in detail the signals that were made just in the past week and what they mean. Before we get started, if you are not a current subscriber to one of our DT reports, I've extended the 1 month $29 trial through this coming Monday, March 25th, because I'm doing this follow-up report that's directly related to the report I did last week. We did have an expiration on that 1 month trial last Monday, but we extended it 1 week, and after Monday, March 25th, it's not going to be available anymore. And of course, it's going to take you through the next month, which will take you through the period when more of these reversals and trend confirmations should be made. So if you like what you hear in this report, you might consider one of our DT reports where we also follow, of course, the stocks, bonds and notes, crude, beans, and some other markets in our regular DT reports. So check them out. Okay, let's get started and take a look at what these signals are that were made last week and why they're important. Well, this is the monthly dollar chart, and of course we had this in the original comprehensive report from a week ago, and the whole gist of our technical analysis and our viewing this chart was to help us to identify when this corrective rally would be complete, this wave B corrective rally. And a week or so ago, had a question mark by that as a wave B near the 62% retracement here. I've taken that question mark off. While if we were just looking at this monthly data, we would only consider that this wave B correction was complete following a trade below the January low. When we focus in on shorter term data on the weekly and daily charts and even down to the 240-minute, they're all giving us signals that this top is complete. So let's take a look at that. But looking at this is what's important is that if this is A and if we are indeed completing a wave B, typically a wave C comes down to test or exceed the wave A low. So that would mean many months of the dollar in a net bear trend. And that's really significant, not just because of a dollar trade, but because so many commodities and other trading vehicles are priced in dollars. Well, this is the weekly data, and here's where we begin to get some key information on this weekly data. Weekly momentum's made a bear reversal a couple weeks ago, or just last week, I believe it was. But what's more significant is 2 weeks ago, just last week, is the dollar closed into the closing range of what I got labeled a wave 3. There we can do, these are just the weekly closes. Made a weekly close back into this range. Actually closed below the low, not only the weekly closing range of 3, but the closing low of 4. Those are two really strong signals that this section of the advance is complete. So why is that important? It's important because once this section is complete, the higher time frame section going back to the February 2018 low should be complete. It also gives us another really important pattern signal, and that is coming up from the January low. This is what we call an overlapping diagonal. And an overlapping diagonal like this, what we mean by overlapping is we had a section up, correction, another section to a new high, but then that correction came into the range of this initial advance. And so it overlapped into that range. Then it went up, made a new high. And then what's since happened is we've come back into the range of this section, which indicates, it's one strong indication at least, that this whole section is complete. So that's called an ending diagonal. Diagonals are typically at the final section of a higher time frame trend. And in Elliott wave terms, we call it ending diagonal, ending 5-wave diagonal. And what's significant is once it's complete, it completes the higher time frame. And when the final section is an ending diagonal, frequently following the reversal, there's a fast, sharp move against the prior trend. Just look at this. This is kind of represented or represents a struggle upward. Yes, it made new highs, but it was struggling up. Popped up, came back, popped up to a new high, came back and traded into that range. Little follow through. Popped up to a new high, immediately came back into that range. So it was a struggle, not any real serious buying power going up to the new high. And once the realization comes that this bull trend is probably over, there can be a real capitulation and some serious selling. Now, that's what typically is the aftermath of an ending diagonal 5 waves. I don't know if that's going to happen or not, whether it's a fast move against the bull trend or a slow move or whatever. It doesn't invalidate that from a pattern position. The only way to look at this, at least from my point of view, is that this advance is over. Of course, we identify what can the market do to invalidate this, in this case, the bear trend. We'll address that in a minute. But this is just really significant. So let's take a look. I'm going to, first, before we go to daily data, I'm going to go to just the June contract weekly data because we had a rollover in the past week. So it kind of skews the weekly data a little bit. It looks a little cleaner here. And again, the ending 5-wave diagonal, we've closed well into the range of the wave 3. And what's also significant, we've actually traded below the low of the wave 4. So that's another pattern reversal signal that avoids the higher highs and higher lows and indicates that this section of the trend is over. When that section of the trend is over, more than likely the higher time frames bull trend from 2018 is over. I showed these in previous reports that there are 3 really important time factors, all ending on the exact same bar, the week ending March 8th. And that would be the low to high, be the high, 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 and high, 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 all coming at the same time. So there's a lot of symmetry in the structure right on the week ending the 8th, and it was also the end of wave 5 price target that was made. So that was pretty significant, and of course we made the dual look back bear reversals in the weekly momentum. So if we're looking, so far we're looking at the data, there's only one conclusion to have, and that's that a significant high has been complete, probably the wave B, and we're going to be sideways to down in a net bear trend for many months, many months. And I'll go back continuous data, eventually should come down to test or exceed the 2018 low. Now that's significant, and it's also a major trade opportunity in the days ahead. Here's the daily data. So this is what we're looking at. Now this data is as of Friday, by the way. I'm recording this around noon Friday, March 22nd. In the written report, all those charts were captured on March 21st on Thursday, so they don't have Friday's data in them. But boy, just right on schedule. The dollar is making a fairly sharp advance here following the dual look back daily momentum bull reversals from right at the 100% alternate time projection. So if we're correct that this is indeed that wave B high, a multi-month high, then this should be, as of Wednesday, that's a wave 1 low, and we're making a wave 2 correction. So the one other thing that I wanted to, well, if we look at this first, daily momentums are dual look back bullish, and they're not overbought. That usually means we've got at least 2 to 3 days, another 2 to 3 days, sideways to up before the daily high is complete. And of course, any daily high we get now should complete the wave 2 high. And it should be complete. And we're going to see this on the 240-minute data. Let me just reduce this a little bit. It should be complete no later than April 2nd on the daily data. That's the 62%. Oh, I'm sorry, that's the 100% time retracement of the wave 1 decline. And that should be the latest, absolute latest before it's complete. As we'll see in a minute, more than likely it's going to be before that. But that would be the very latest. That would be not this coming week, but early in the following week. Ideally, it's complete around the 27th, and that's next Wednesday. And what's that? Well, that's the 100% high to high to high. So we'd want to be aware of the 27th particularly, and we'll see in a minute. 26th to 27th are the two key time dates to complete a high, and that coincides perfectly and corresponds perfectly to a probable daily momentum bear reversal, which should have another 2 to 3 trading days before it's complete and makes its bear reversal. Let's go look at the 240-minute data. I know I'm going into a lot of detail on this, and the reason is I think we have an enormous trade opportunity coming up just in the next few days following these major bearish signals that have been made this past week. So there's the 240-minute data. Into Wednesday's spike down, this was during the FOMC meeting. I think there's also some announcement that has to do with Brexit in the UK and all of that. But spiked down really hard, completing a five-way structure. 1, 2, 3, 4, 5. Closed below the February 28th low, very bearish signal. Five-wave pattern, very bearish signal. Because a correction should not be complete in 5 waves, and 5 waves should indicate that the higher time frame trend is bearish. So this should be, typically we'd label this a wave 1 or an A. I'm labeling it a wave 1 because of the higher time frame technical position at the March 7th top to complete a multi-month high. So this should only be a wave 1. We're making a wave 2. 62% time retracement of wave 1 is on Tuesday the 26th. And that's typically the maximum for a wave 2 correction. On the daily data, I showed the 100% time retracement, and that's always considered the maximum. But this is typically, I should say, this is at the maximum typical range. The wave 2 typically retraces 38 to 62% of the time of wave 1. So we have the 26th, we have that high to high that was on the daily data, the 27th, and that's why I say 26th to 27th, which is next Tuesday or Wednesday, are the high probability time target to complete a wave 2 correction. So that's what we're going to be looking for. And again, if March 7th completed a ending diagonal 5-wave trend, which completed the bull trend from the 2018 low, and if we're going to be completing a wave 2 correction next week, followed by the continuation of the bear trend in a wave 3, wave 3s are usually faster, greater in time and price, etc., than wave 2. It's another reason, or excuse me, wave 1, another reason to anticipate the potential for a significant move once this correction is complete. So that's why I'm really focusing on this in the next week. And of course, we look at the euro and it just trades inversely. So there's no reason to even go through euro charts here because they're the exact inverse of what we're looking at for the dollar. Well, now this is what's important. What would void this idea that we're having and let me put this on first, we're in the beginning stages of this major bear trend, this wave C correction. Well, one of two things. One thing would be a strong warning, another one would simply void it. So the first warning would be, should the dollar make a daily close above the 78.6% retracement. That's at 96.73415 on the June contract. Typically, the 78.6% is the maximum correction for wave 2 and for really just about any correction. And a daily close above it would be significant. It would indicate that it would be a really strong warning that we're not correct. I'd be taking a close look again at the analysis, look at the pattern of the advance off of the March 20th low, etc. Definitely a trade above the March 7th high indicates that that's, of course, not the end of the trend at least as I identified it. Doesn't mean we're not near a weekly high, but it's potentially not as important a high as I considered. And it's not unfolding in the way that I thought it was going to unfold. So just a trade above the March 7th high. That's not just a warning that what I'm looking for, this major bear trend, is not correct. It would have to be a total reevaluation of how important a high might be that being made around this time. So those are the two signals that we'll be looking for that will at least warn what I'm looking at is incorrect and will tell me definitively that the kind of bear trend I'm looking for is probably not going to unfold. If in the next few days we make a DT oscillator 8 look back bearish reversal in the daily momentum, that will put the daily momentums in alignment with the bearish weekly momentums to give us a warning that a wave 2 corrective high is complete and a wave 3 continuation of the bear trend is about to begin, potentially in quite a fast move to the downside. So that's what we want to be aware of, and that's literally want to be aware of that in the week ahead. And needless to say, we'll keep you up to date on that every day with our DT reports. Well, this is the weekly data of the dollar and gold shown both on the same chart. And it's the same chart I've got in the written report. So I'm going to review a little bit more detail the comments I had in the written report. The main takeaway from this chart is that the gold and dollar tend to trend inversely or against each other. In other words, when there tends to be a longer term net bear trend in the dollar, there tends to be longer term net bull trend in gold. They don't reverse at exactly the same time, and sometimes one can move against the other. Or I really should say, they can both move together in the same direction for a period of time, but eventually that's going to get resolved, and that the net trend is likely to be inversely related between gold and the dollar. We can look at this 2006 into the 2011 low in the dollar, and it wasn't a straight down bear trend, but it was straight down for a couple, 3 years. Then we had these multi-month declines and advances, and again to almost test to make a double bottom in the dollar before the major trend reversed. And through that period, gold was net bullish, and they tended to make the major reversals right around the same time. So that's significant, but we can see they also, there were periods of times, even for months, when they traded coincidental to each other. They weren't always directly inversely related. And then here's just another major bull trend in the dollar that lasted several years. And it wasn't straight up, it was up and sideways and had corrections along the way. But the lesson to be learned, the takeaway is during that period of time when it was a consistent bull trend and always any corrections that were made eventually resolved themselves to a new high, is gold was net bearish throughout that entire time. So they didn't trade directly and inversely. But we certainly, if our technical analysis would say more than likely we've got a ways to go in a dollar bull trend, we wouldn't get too excited about gold, as that gold would probably be net sideways to down until the dollar reversed into a bear trend. And again, they don't trade inversely. Sometimes a decline, multi-month to even multi-year decline, bear trend in the dollar will just mean gold is sort of net sideways to up, mostly sideways. What it does is it's supporting gold. We would anticipate that gold would not have a bear trend while the dollar was having a bear trend, that it would be, again, sideways to up. So if we're on the verge of a significant and multi-month, if not 1 to 2 year, bear trend in the dollar, what would we expect in gold, just in general? Well, in general, we'd say gold's probably going to be supported. It's going to be sideways to up. May have a significant bull trend, inversely to a significant bear trend that the dollar has, but at the very least, it's not going to have a bear trend. At the very least, it should be net sideways. There's be support in the market and potentially significant upside available. So to me, that's really important information to have. And it's very logical information. Gold's priced in dollars. If dollars are cheaper, there's more demand for gold because it's a lot of the other currencies during this period could be strengthening, and they're able to buy gold for them at a non-U.S. currency at a cheaper price. So that's one of the reasons more than likely gold will be sideways to up in the months ahead, if indeed the dollar continues to decline. And of course, there's many other commodities and all that will be supported if the dollar has a consistent bear trend. So for those of you who are interested in other commodities and markets that are priced in dollars, and you might want to take a look at, get 10, 15, 20 years of data up there of the dollar and compare it with your market and see what happens when we have significant multi-month or multi-year bear trends in the dollar. How do those markets react? Well, that's the dollar and gold. And of course, if you read part one of that I did a week ago, I went into a lot of detail about gold standing on its own, no comparison to the dollar like we're doing here. Standing on its own, which it's independent, and looking at it independently, technical analysis is by the end of next week, the very latest the following week, in other words, around late March into early April, should be a corrective low in the dollar, which is likely to be followed by a continuation of the bull trend. So even if we weren't looking at the relationship, and I think I said the dollar, I meant gold, correction in the gold following by a bull trend to a new high. So even if we weren't looking at the relationship of gold to the dollar, we'd be looking for the resumption of a bull trend in the dollar within the next 2 weeks. And ideally, I think it's around the 27th or 28th, which is near the middle to the end of this coming week. Fantastic setup to be aware of. If you're interested in Bitcoin, you can take a look at the written report, as I have a dollar Bitcoin chart showing how they tend to trade inversely to each other. And again, if you want to follow these markets in the weeks ahead and you're not already a subscriber, really consider just at $29 for a 1-month trial. That's going to take you through, well through the period when all these trends should reverse and confirm the continuation of the trends as well. There's going to be some real important technical signals, not just in the dollar and in gold or in Bitcoin, but also in the interest rates. Of course, the euro, that's inverse to the dollar, and in the stock indexes, we think there's a major signal coming up just in the next few days. So I hope you'll consider our reports. This $29 trial, that offer is good through this Monday, March 25th. Then we take the offer down, and we're just at the regular subscription. So I hope you have a fantastic week. Check out our DT reports, and good trading for all of you.